21 miles. That is the width of the Strait of Hormuz at its narrowest point, a sliver of water pinched between Iran and the Oman Peninsula. 21 miles of ocean that carries roughly 1/5 of the world's daily oil supply. Every supertanker threading that passage is, in effect, a pressure valve regulating the global economy. And right now, on the morning of March 10th, 2026, that valve is being closed. What you're watching unfold across every financial screen on the planet is not a correction. It is not volatility. It is not the market taking a breather. It is the economic consequence of a single geographic choke point being disrupted by active military operations, and the shockwave moving at the speed of capital through every stock exchange, every bond market, every digital asset platform on Earth in real time. Japan's Nikkei 225 lost more than 7% in a single session. South Korea's KOSPI dropped over 8%. Hong Kong, India, Germany, France, London, every major index on the planet is in free fall simultaneously. US futures for the Dow, the S&P 500, and the Nasdaq are all down more than 2%, and the trading session has not even opened in New York. And yet, in the middle of this synchronized global liquidation, silver is trading at $80.80, down just 1.28% on the day, still up 18% for the year. And the financial media is presenting that modest single-day pullback as if it were confirmation that precious metals have failed. As if the asset class that has preserved wealth through the fall of Rome, through the Weimar hyperinflation, through the 1970s oil embargo, through every sovereign debt crisis in modern history, as if that asset class is the problem today. This video is about why that framing is not just wrong. It is the inversion of reality. And by the time we are done, you will understand exactly what is happening, why it is happening, and what the historical record says happens next to the one market that almost nobody on mainstream financial television is taking seriously enough. To understand what is actually moving these markets, we need to go back 48 hours, because the mechanism that broke everything this morning was already in motion on Friday night, and almost nobody saw it coming. On Friday, Brent crude closed at $90 a barrel. By Monday morning, it was trading above $114. That is a 26% increase over a single weekend. A move that, in the entire history of the oil market, has only occurred during wars, embargoes, and what analysts politely call civilization-level supply disruptions. This time, all three apply simultaneously. The conflict involving Iran escalated dramatically over the weekend. Israeli strikes targeted key Iranian energy infrastructure. Iranian forces retaliated against strategic regional assets. And then the cascade began. Kuwait announced production cuts. The United Arab Emirates followed. Both joined Saudi Arabia and Qatar, which had already curtailed shipments. The Strait of Hormuz, that 21-mile choke point, became an active zone of military operations, rather than a theoretical geopolitical risk. 1/5 of the world's daily oil supply went from flowing to contested in the span of 72 hours. Now here's the mechanism that the financial media is covering in fragments, but refusing to assemble into a single coherent picture. Oil is not just an energy commodity. It is the cost basis of the entire physical economy. Every product manufactured requires energy. Every product transported requires fuel. Every building that stores inventory requires electricity. Energy is embedded in the price of everything that exists in the material world. So when oil rises 26% over a weekend, it does not merely affect energy stocks or airline margins. It reprices the entire global earnings landscape overnight. The mathematical logic is this. Equity markets are priced on future earnings expectations. Those earnings models were built on assumptions of $80 to $90 oil. At $114 and trending toward $120 or beyond, every corporate cost structure on the planet just got revised upward while revenues have not moved a dollar. Profit margins compress, earnings estimates get cut, and the valuations that justified stock prices at current levels evaporate. That is the arithmetic behind the Nikkei losing 7%, behind the KOSPI losing 8%. It is not panic selling. It is rational repricing of a world that just became significantly more expensive to operate in. But here is where this crisis transforms from serious into something categorically different. On Friday morning, before the oil shock landed, the U.S. Bureau of Labor Statistics released the February Non-Farm Payrolls report. The economy did not add jobs last month. It lost them. 92,000 positions vanished from the American labor market in a single month, against market expectations of a 59,000 job gain. The unemployment rate ticked up to 4.4%. The previous month's number was revised downward. The labor market, in other words, was already weakening before oil hit 114. Put those two data points together, a contracting labor market and an accelerating energy-driven inflation shock, and you arrive at a word that should unsettle every investor, every central banker, and every policymaker watching these numbers: stagflation, an economy simultaneously shrinking and becoming more expensive. And if the pattern unfolding right now is starting to click into place for you, if you are already connecting this to things you have noticed in your own financial life, hit like and subscribe. Because what we are about to get into is the part that changes how you see every financial headline from here forward. The reason stagflation is so dangerous is precisely because of what it does to the institution that is supposed to manage these crises. And right now, that institution is completely out of options. The Federal Reserve has two tools. It can raise interest rates to cool inflation. It can cut interest rates to stimulate a struggling economy. In a stagflationary environment, both tools backfire. Raise rates into a labor market losing 92,000 jobs a month, and you accelerate the contraction toward recession or worse. Cut rates into an oil-driven inflation shock, and you pour fuel onto price pressures that are already surging through every supply chain on Earth. The CME FedWatch tool, which tracks market expectations for Fed policy, is now showing a 95% probability that rates remain unchanged at the March meeting. The most powerful central bank in the world has been rendered a spectator, not by choice, but by arithmetic. This is the hidden catastrophe inside the obvious one. The market crash you can see on your screen is the surface event. The deeper rupture is the revelation that the institution tasked with managing economic stability has no lever to pull. The Fed spent years telling markets it had the tools to handle any scenario. In 2021, it called inflation transitory. In 2023, it called the banking system sound, days before 3 institutions collapsed in a single week. Now the scenario is stagflation, and the answer is silence. The credibility gap between what central banks have promised and what they can deliver is wider today than it has been at any point in the post-2008 era. And into that credibility, vacuum flows an asset class that has been building a very specific case for years. But before we get there, we need to talk about crypto. Because what happened to Bitcoin this morning is perhaps the most important data point in this entire story, and almost nobody is framing it correctly. Bitcoin is sitting at $65,000, down sharply. The total crypto market cap has dropped below $2.28 trillion. And the collapse of the digital asset market in the middle of a global financial crisis deserves a direct question. Where is the digital gold? Where is the inflation hedge? Where is the store of value that was supposed to outperform during exactly this kind of systemic stress? The answer is that crypto is not behaving like gold. It is behaving like a leveraged tech stock. The fundamental thesis for Bitcoin and the broader crypto market in 2026 was built on a specific bet, that the Federal Reserve would be cutting rates and injecting liquidity into the financial system, making risk assets attractive. Now the Fed is frozen, inflation is surging, and the entire rate cut thesis has been invalidated in a single weekend. When margin calls go out to leveraged crypto traders, they liquidate. When institutional portfolios need to raise cash, digital assets get sold. The market that was marketed as the crisis hedge is instead behaving as a crisis amplifier. This is not a temporary glitch. It is a structural exposure. Crypto correlates to risk appetite. And right now, global risk appetite is in freefall. Bonds are selling off. The 30-year Treasury yield pushed to 4.84%, meaning the supposedly safe haven asset class is under pressure alongside equities and crypto simultaneously. Stocks, bonds, and digital assets are all losing value at the same moment, which creates a question that seems simple but is, in fact, the single most important question in global finance right now. Where does the money go? Because it does not disappear. Capital does not evaporate. It migrates. And if you have the historical record in front of you, and we do, the destination is not a mystery. What happened next is the part that most analysts are still afraid to say plainly. Gold fell 1.12% today to $513 in the spot market. Silver fell 1.28% to $82.80. And the financial media has chosen to present those figures as evidence that the precious metals trade is broken, that even the supposed safe havens are not safe. That framing requires a very selective reading of the data. Both metals are still up 18% for the year. The reason they are pulling back today is not weakness. It is a well-documented phenomenon that occurs in every acute liquidity crisis, forced selling of winners. When margin calls arrive and traders need to raise cash immediately, they sell the positions that still have gains, because those are the only positions left with profits to harvest. In a world where stocks are down, crypto is down, and bonds are down, a position up 18% year to date is the most liquid source of emergency capital available. That selling is temporary, it is mechanical, and it has nothing to do with the structural thesis for precious metals. Here's what that structural thesis actually looks like right now, assembled from every direction simultaneously. The COMEX, the primary exchange where physical silver contracts are settled, is holding 86 million registered ounces available for delivery. The projected annual supply deficit for silver runs between 67 and 100 million ounces. That gap between available supply and structural demand is not a rounding error. It is a physical impossibility that the market has been papering over with financial instruments, and those instruments become increasingly fragile as the physical reality tightens. On the demand side, the pressure is building from directions that did not exist even 5 years ago. Solar manufacturing toward the European Union's 700 gigawatt renewable energy target requires massive quantities of silver. Electric vehicle adoption is driving silver consumption growth of 3.4% annually. Artificial intelligence infrastructure and semiconductor manufacturing are creating entirely new categories of industrial silver demand with no historical precedent. And critically, more than 70% of global silver production is a byproduct of copper and zinc mining, meaning supply cannot simply respond to higher prices the way it would in a conventional commodity market. You cannot open a silver mine overnight. The supply is structurally constrained while demand is structurally accelerating. Citigroup has published a $150 price target on silver for the second quarter of 2026. JP Morgan is marking $81 as a floor. Goldman Sachs has drawn explicit comparisons between gold's trajectory toward $5,400 and silver's potential for an even more violent percentage move, given the gold-silver ratio compression that is already underway. Silver was added to the United States critical minerals list, a designation that signals strategic importance to the government itself. And then there is the scenario that nobody in the financial media is thinking through completely. There are two plausible paths forward from this crisis. If the conflict in the Middle East continues and oil stays elevated, inflation surges, stagflation deepens, and silver performs as the definitive stagflation hedge, potentially targeting $150 and beyond. But if a geopolitical de-escalation occurs, if pressure from collapsing equity markets forces a ceasefire or negotiations, oil falls and the Federal Reserve suddenly has room to cut rates. A weaker dollar from rate cuts, combined with a labor market that just printed negative 92,000 jobs requiring stimulus, creates the loose monetary environment that has historically been the single most powerful tailwind for precious metals. Two completely different scenarios, one destination. Here's the question I want you to sit with, and it is one that mainstream financial coverage is conspicuously avoiding. If the three largest asset classes on Earth, equities, bonds, and digital assets, are all declining simultaneously during the crisis they were each supposed to help investors weather, what does that tell you about the foundational assumptions of the modern portfolio? Drop your answer in the comments. I read every single one. Because the most important conversations about what comes next are not happening on television. And this is the moment when the question stops being academic and becomes personal, because what we are describing is not happening in some distant financial abstract. It is happening to savings accounts, to pension funds, to retirement timelines right now. 21 miles of ocean. That is where this story started. And it is worth sitting with that image for a moment. The idea that a waterway narrower than many cities are wide could constitute a single point of failure for the entire global financial architecture. Not because the Strait of Hormuz is uniquely fragile, but because the system built around it is. The modern financial system operates on a set of assumptions, so deeply embedded that most people never examine them. The assumption that energy is abundant and accessible. The assumption that central banks can calibrate between growth and inflation with sufficient precision to prevent either from becoming catastrophic. The assumption that digital assets represent a new form of crisis-resistant money. The assumption that bonds balance equity risk in a diversified portfolio. What Monday, March 10th, 2026 demonstrated is that all four of those assumptions can fail simultaneously, and that when they do, the assets that were designed within that framework fail alongside it. This is not a prediction about collapse. It is an observation about architecture. Every financial system in history has embedded within it a set of assumptions about the world it operates in. When those assumptions encounter a reality that contradicts them, a war, an energy shock, a monetary policy trap, the system does not adapt instantly. It reprices, sometimes violently. The question for any investor watching these markets is not whether they believe the assumptions are flawed. The evidence is making that argument for you. The question is what you hold while the repricing happens. There's honest uncertainty here worth naming. We do not know how long the conflict escalates. We do not know whether political pressure from crashing equity markets produces a rapid de-escalation. We do not know the precise timing of the silver supply deficit becoming impossible to paper over with financial contracts. These are genuine unknowns, and anyone who presents them as certainties is selling something. What is not uncertain is the direction of the underlying structural forces. A physical commodity in a 6-year supply deficit with industrial demand growing from multiple directions that did not exist a decade ago, with financial institutions from Citigroup to Goldman Sachs publishing price targets that imply significant upside from current levels, is not a speculative story. It is a supply and demand reality that the paper market has temporarily disconnected from. Those disconnections eventually close, and they tend to close faster and more dramatically than most people expect. The 1.28% single-day decline in silver is not the signal. It is the noise The signal is the synchronized failure of every alternative. The signal is $114 oil and negative 92,000 jobs in the same week. The signal is a Federal Reserve with no viable policy response. The signal is Bitcoin confirming it is a risk asset in the moment it was supposed to be something else. When you remove the noise and look only at the structural pressures on supply, on demand, on the credibility of competing assets, on the monetary policy environment, the picture that emerges is not complicated. 5,000 years of monetary history have a pattern. When the paper system strains under the weight of debts it cannot service and promises it cannot keep the assets that carry no counterparty risk, no issuer, no balance sheet, no promise that can be broken, become the foundation that the next system is built on. That has happened before. It is happening again. And the price of silver at $82.80 on the morning the evidence became impossible to ignore is either a warning you acted on or a story you tell later. The Strait of Hormuz is 21 miles wide. The gap between what the financial system is promising and what it can deliver is wider. Now you can measure both.